How is a catastrophe determined in the insurance industry? Insurance is a highly regulated industry because of the economic damage widespread failures could cause. The regulator will tell insurers that they have to calculate their solvency based on a catastrophic event of a certain probability in that year, for example an event for which there is a 0.5% probability, what's called in the industry a 1 in 200 year event. The insurers then use a catalog of tens of thousands of possible events that could affect them, different hurricane tracks and wind speeds, different earthquake locations and intensities and so on. They take their exposures from all the policies on their books and compare them with this catalog, to reach their 0.5% probability catastrophe event. They have to hold sufficient assets that they can pay all the claims from that event. The word event is very important because typically insurers buy reinsurance to protect themselves in case of really severe claims, and the reinsurance contract will define event quite specifically. For instance, there can be one severe storm system or a series of bad storms over a longer period. Both do a lot of damage, but they may not both be considered as one event. If they are, the insurer gets a recovery from the reinsurer, but probably not if the storms continue over, say 10 days. When a severe event occurs, often an industry-wide or independent loss verification body will state that a particular event is a catastrophe and give it a name or number so the industry can monitor the total claims. Most of the major insurance companies use a dollar threshold to declare an event as a catastrophe. That means as if a large-scale event, another word for a storm or hurricane, etc., happens and the company determines their losses are going to exceed a certain preset amount, they will declare the incident as a catastrophe loss. The reason for doing this is it allows the insurance company to put all claims attributed to the occurrence into one folder, so to speak. This allows the company to track how much money they pay out in losses. This is done for two main reasons. Number one is many insurance companies carry reinsurance through another company that will reimburse them a percentage of their losses after they reach a preset amount. Sometimes it may be $100 million or more. Number two reason is when they post their financials at the end of the year, losses are added in on a separate line from their regular losses. Investors want to see how the company performs year over year, and no one can forecast a catastrophe. This allows the company to show their performance before and after the catastrophe losses are included. In the insurance industry, a catastrophe is an unusually severe disaster that results from natural or man-made causes. According to the Insurance Information Institute, a catastrophe is declared when losses meet a certain dollar amount, which they stipulate to be $25 million. Also, the losses must be felt by a certain number of individuals and insurance companies. Typical events that can lead to catastrophes include hurricanes, earthquakes, tropical storms, tornadoes, floods, terrorism, fires, and many other perils. I would think when claims are so great that you go out of business. Like what happened in CA years ago to companies that offered earthquake insurance, then we actually had a fairly major quake, and many companies went out of business. One more reason, as a side, I find a lot of insurance to be simple fraud. They sure collected those premiums, didn't they? But when the quake happened it was, well, we don't have enough money to pay everyone.